recorded. In fact, all our classes are recorded. So, on that note, I welcome you all to this wonderful edition. Today, Wednesday, we shall be looking at the first topic in our week 2, right, which is on business decision making with data. I hope I am audible enough and clear enough. Hello.
Yes, you are clear.
Okay, thank you. So we shall be looking at a very important topic today, which is on understanding key business metrics. This class would have a hands-on session. I mean, would create time for hands-on, but despite that, we would still go through a lot of, some. I don't want it to sound like boring theories, but they will be more of theoretical because we need to understand the theory behind what we do, right? On that note, I introduce to you the topic for the day, which is on understanding key business metrics. And in today's class, we shall be looking at a number of things, which is to introduce what business metrics are, and then to understand the difference between a metric and a KPI. KPI, which stands for key performance indicators. Then a kind of advice or insights on how to choose the right metrics, things to consider in choosing the right metrics for your business as for your business needs. Then we'll now proceed to the hands-on, which is to build a report displaying key business metrics. So the hands-on is going to be more of to have, oh sorry, this is misleading. Actually, this Power Query is misleading. I think I just edited the templates I've been using for this, so please ignore this. Thank you. So the hands-on is going to be more of to see how we can calculate some of these metrics for in our analysis, right? In Excel, of course, we are yet to start using Power BI. So these are the 4 things we are going to focus on for the day. And on that note, we begin in earnest. So first of all, what is a business metric, or what are business metrics? Okay, before I give a formal definition, you can see it as substance, the substance that you can hold on to as a decision maker, like the substance that data offers you, which you can hold on to, which you can always track and all. Now, a definition here by TechTarget says that a business metric is a quantifiable measure that businesses use to track, monitor, and assess the success or failure of various business processes. Underlined here is quantifiable, meaning that a metric has to, in some ways, be quantifiable. Quantifiable means you can have a number, a numerical value attached to it, which you can always track. Now, why are these metrics necessary? They are essential because they help us in driving informed decision making. Now, the word there, substance. By the word substance, I want us to imagine something that once existed in form of idea, right? Now materializing into something concrete, tangible, or even physical that you can hold on to, right? Substantiation, to substantiate something, means to add substance to it so that it is not just fluidly, like it's not just like a fluid. Once something is not substantiated, it can vary depending on who is looking at it. Like now, if we want to say someone is fair or someone is dark, that quantity, fairness or darkness, can be relative because it all depends on who is seeing and who is saying, right? But imagine we have a device that measures degree of fairness, and then that now says that at a certain degree of, let's say, if someone scores up to 5 points of a measure, right, the person can be considered fair. Otherwise, those anyone below that particular um, measure is treated as dark, right? Now, by that very definition and by that very benchmark, we have substantiated the concept of fairness, right? So it no longer stands to be argued. If you feel Mr. A is fair and I feel Mr. A is dark, then we can just bring that device, right? Let me call it ferrometer. I can just bring that device and plug in the data from Mr. A. Did Mr. A score up to 5 points? Yes. All right. In that case, Mr. A is fair. Mr. A did not score up to 5 points. Therefore, Mr. A is not fair, but dark. When you are working in teams, like in a business setting, people tend to have their different opinions of what they feel is good enough, right? But until we establish critical criteria that we can use to determine what good enough is in our own situation or for the purpose we want, for our own intended purpose, we may end up having misunderstandings among ourselves, right? We may end up misunderstanding ourselves, or we tend to feel this one is going extreme, or this one is supporting mediocrity. We are being mediocre, or we are being too over ambitious. So that's what the substantiation here implies. It should be quantifiable such that if we agree that we want to have a target of 5,000 website visitors per month, if the number of visitors we got in a particular month is not up to 5,000, then we can all agree that we did not hit our target. Now, as part of the needs for metrics, they help in driving informed decision by helping to back up our decisions, like for key decision makers. They provide the data-backed insights for strategic decisions that's based on performance trends rather than intuition or guesswork. And this still, in a way, falls back to the explanation I've given prior to now, right? Instead of relying on your intuition, which in many cases may not offer us something concrete, or which could be influenced by your current feelings, right? Or current level of exposure. Metrics helps us to know, to be able to have something standard that can apply to many cases. The second thing here is that they help us to measure progress towards goals, in the sense that if a business is trying to set up the target for the year, then they first establish the metrics they would want to track, right? They first establish these metrics and then they start working. If by the 7th month they have not made up to 50% progress, then it's time for them to realign and then devise a more effective strategy to help them hit that goal, right? Otherwise, if they check and they see that yes, they have made some good progress, then it could be time to yes and say yes, this method, this strategy is really working. Let's keep up with that. The other one about the other need for metrics is that they help to identify strengths and weaknesses. It helps us to know what is working and what is not working. Imagine you are trying to run an advert and then you've spent up to 500,000 naira on a campaign on a particular social media channel. Let's say you are targeting business owners and you launch these adverts on a platform like Facebook, and you see that you are not getting quality leads, right? You are not getting quality leads. Then it could be time to know that this channel may not necessarily be where our audience are, right? Let's focus elsewhere, right? So with this, you have seen strengths and weaknesses, what is working and what is not working, what needs to be improved, and all that. And then finally, in this slide, is that metrics help us enhance accountability for us not just to hold teams responsible, but for us to also be able to set realistic targets, right? So they help us to hold teams and individuals accountable and by setting measurable targets so that if someone feels they are working hard enough but they have not hit the target, then we can use their own performance to compare with the performance of others in their team and then really know who is working hard and then who really needs support. And then we will always remember to approach this with the mindset of helping to improve the process, not just to witch hunt in a way or to make people feel they are ineffective, right? But someone may be working hard but not hitting the targets that the rest are hitting. Then it's time to realign and see if the person really needs special support to help them get by their odds or whatever may be keeping them below the line. So these are the 4 points we should keep in mind about metrics, right? But then there are still many other reasons why we need to have establish metrics for our business purposes. So the other thing we would look at now is metric and KPI. KPI stands for key performance indicators, like KPIs, key performance indicators. I know many of us may have heard this over and over before now. Now, what is a metric and what is a KPI? Okay, we've defined metrics before now in the previous slide as quantifiable measures that businesses use to track, monitor, and assess the success or failure of various business processes. Now, for KPI, a KPI is the first and most important point to note here is that a KPI is also a type of metric, right? A KPI is a metric. There are specific types of metric that are directly tied to strategic goals and critical to achieving business goals. What KPIs mean here is that there could be many metrics to track, right? And sometimes it can be overwhelming. Other times, depending on what we want to focus on at the moment, tracking all possible metrics can be unnecessary. They can be unhelpful to us, given that they may not really help us. Not all of them may really help us to achieve the intended goal or focus of a business, right? But KPIs are like a subset of those metrics that we have chosen to prioritize. Those are KPIs. That's why they called key performance indicators. We might fail in a number of metrics, but if we check our KPIs and then we are still on track, then we will still call our efforts a success, right? Because KPIs are the ones we have chosen to prioritize. So in terms of purpose, we have that metrics provide a wide array of data that can be useful for monitoring daily operations and understanding various aspects of performance across the business. You should see metrics as a general purpose something, right? But KPIs focus on the most important aspects of performance. They highlight whether the company is achieving its key objectives and provide insight into whether strategic initiatives are on track. The need for KPIs can stem from the current stage of a company's or a business. If for a startup that just launched 2 months ago might heavily be interested in creating awareness first, or a startup that is just at the pre-launch phase, right, may be more interested in creating awareness first about their launch and then maybe initiating pre-launch orders, getting people interested, signing up on their mailing list, and then a lot of other balls that they need to create online. In that case, they might be more interested in engagement. They might be more interested in number of likes, number of followers on social media, and all that. But for a company that is already established, that has been there for the past decades, well, They may also have established a very robust social media base, and their focus at that point might be on how to convert these people into actual sales, right? Or how to optimize or improve the experience that their audience have. So depending on the current stage of your business, your focus might vary. That is why we need to always keep in mind the ones that matter most to us, and then those are the ones we call KPIs. I hope that's clear. Are you with me? Can I confirm that you are still together before I proceed?
Yes, yes.
All right,
Yeah, we are together, sir.
thank you. So the next thing we will look at now are um, how to identify relevant metrics to track for your business, things that you need to consider. And the three key things you need to consider are the industry you are operating in, the goal of your business, and even your role, right? Even your role in that particular organization or business. Your role could be that you are among those in the operations team. You could be among those in the executive or management team, or whatever role you are currently at. Your metrics, the metrics that may be more relevant to you, um, might vary from the other person. Now, your industry. If the industry you work in, normally there should be the industry you work in becomes handy because sometimes they offer you the benchmark, like the benchmark to compare your efforts to what other businesses are doing to really know whether you are still on track. People in the pensions, that's pensions and savings pensions sector, right? They normally have their average retention rate, let's say customer retention, than those in other sectors in edtech. For instance, people in pensions, their retention rate could be somewhere around 84% on average, but edtech may just be around 4% retention rate. We're going to look at what retention rate is in the coming slide. Now, knowing your industry can help you to know that you are still in line, so that if your retention rate is somewhere far below the industry average, then you would now know that something is actually wrong and needs to be improved. But if on the other hand your retention rate is on the high end, right, then you would say yes, we are on track. And then your business goal, I already explained that in the previous slide, where I gave the instance of your current phase, the current stage of your business, like startups and already established businesses. So your business goal is another key factor to determine or to consider what to prioritize or what to track, right? Then your role. Usually, people in the higher tiers, like people in the management um, tier, right? They may they may gain more from looking at things from a higher level, right, than those in the operations or, I mean, by this I mean it could be a VC or a manager overseeing the business of your organization. I mean, across, maybe you are the one overseeing the operations of the business across a continent, like on a continental scale. You are in charge of the business, overseeing the business. Maybe you are like working for Microsoft, for instance, and all business operations going on in Africa, you are the one overseeing it and reporting to the higher executives, right? It may be overwhelming to come and keep track of, or to come and start seeing things at so low levels. That's micromanagement. Instead, you may gain more from looking at things from higher level, like aggregated form, looking at it at country levels, and then like that. But if you are someone in the implementation team, your own metrics that you might gain from might be those that directly relevant to what you are achieving. Maybe you are in the software development team, you might be interested in keeping track of number of downtimes or number of bugs reported or other similar things, right? So your role can largely influence the key metrics to monitor or to track. So the slide here gives us examples of certain metrics that you can track depending on your sector. But this is just like a kind of an overview. So the first sector we have here, like this, is like more of a sample use case, different ways that businesses might approach this depending on the industry or sector. So the first sector we have those in finance sector. Those in finance sector, they could use metrics could help them to assess the gain or loss generated on an investment relative to its cost. It could also be an investor that is looking for a, let's say, a business with potential value. Let's say you are looking for a business with high potential for profitability, right? You would want to monitor their past performance. You would want to monitor their um, returns, like their profitability in terms of not just revenue, but net profit from the revenue. Let's say you are trying to consider how efficient is this business. They may be making generating a revenue of 5 billion, but when you subtract cost of service and cost of production and all that, you see that the revenue may just, I mean, the resulting profit may just be somewhere very, very, very low, right? So it then shows that that business does not have good um, efficiency, and they may not, even though they are realizing huge amounts of money, but the profit that comes to you in the end may just be so minute. Or so those are the things that you could keep track of. That's for those in finance. The other one is for those in sales. You, as a business, you may be interested in knowing um, the cost or what it takes to acquire a new customer, and you can use the insight you gain from this to optimize your sales and marketing spend. If you now discover that a certain group of customers cost higher to acquire, right? And at the same time, they still have the tendency to churn, like to stop buying after, um, let's say, after the first patronage, they just patronize you once and then they stop buying. Or you, or just those certain similar factors. If you discover something like that, then you can use this insight to say, okay, this group, we cannot prioritize them because they are not our ideal audience. They are not our ideal target audience. Can we focus on the other group? The other group could be just a matter of age difference, or the industry. Maybe you want to choose to focus on target audience in a different industry or different age group or different country or similar things like that. Now, the resulting gain here is that you have used the insights you got from this to now inform your next marketing effort or your next sales effort, right? Then the other one is the marketing sector. Sales and marketing, they are usually interwoven, but I just try to separate them as much as possible. So here a business might be interested in measuring the percentage of users who complete a desired action, or such as purchase or sign up. It's in marketing terms, it's usually called conversion, and conversion can be defined by, conversion is something that goes by how you define it, right? My conversion can be that if someone subscribes to my list, my newsletter, if my goal, my purpose is for someone to subscribe, for visitors to read through my website and subscribe to my newsletter, and I call that conversion in quotes, then whenever someone subscribes to my newsletter, then the person has converted. And if I'm tracking these metrics and I discover that out of 5,000 people that visited my website in the month of March, only 200 converted, but in the previous month, like in January or so, about 1,000 converted, then it's a good time for me to now say, I mean, or look at what could have gone wrong and what can I improve, right? So that's it for marketing. And then those in product development, we could use metrics to assess customer satisfaction with the product. Not just customer satisfaction. A typical example I can give is I once worked with okay, in a company, like a software development company, and a number of things were happening in the stock exchange industry, like in the stock exchange industry. And then it just happened that the number of users doubled by like doubled within a space of within 1 month. We were able to double the number of average users for the past 1 year in just 1 month. Now, the result, the implication was that the software application took longer time to load. Like there were a lot of issues. To even load the website was a big deal. Why? Because the resources we were utilizing before can no longer support the current request or demand for the product. Now, imagine that as a business, you are not tracking this. You would not know when to scale up, when to subscribe for higher hosting plan or for higher bandwidth, or when to even know if your hosting service provider is still good enough for the size of your business. That's to know when to switch or when to subscribe for something higher. So tracking certain metrics like downtimes, average time to load, and then other things can help. Another example is you could have some really good features in your product that people don't even know that they exist. They are looking for those features in other products, but you have them in your product. So those features that people don't normally use, which you think are very, very important or very, very useful, or that they would find them very valuable. If you discover that people are not using these features, then it's time to maybe the features are somehow hidden deep inside the product that you need to make them kind of more accessible. These are typical use cases whereby of how tracking metrics in businesses can help us. And using the example of features, you could easily do this if in the product you let's say you have functions, and each of the functions in your product or in that particular application, you give them ID. The software development team should be able to implement this so that the IDs of those functions or features that people call the more, you can even use them to know which features users find more useful. And you can even use other measures to know how people even interact with your product. It was through certain studies that people discovered that um, people tend to skim through a website, not even necessarily reading it like you want them to do. Therefore, if you provide the text on your web page in, let's say you are using headings, breaking them up in headings and sections, then people tend to engage more than when you just have a wall of text all over. And people also tend to read in this format from left to right, right? And all that. And those, if you discover that people using your website or your product visit it with mobile more than website, I mean more than desktop, then you are likely to gain more of their engagement by making the clickable buttons for mobiles bolder, because people tend to struggle with when people are interacting with your product with mobile, they tend to struggle with space. Like mobile has a very limited space, so if you are placing your buttons, you have to place them in a strategic way that it will be easier and obvious for people to click, right? But you will not know all this. You will not even know what to improve if you don't know whether people are visiting your website or product with mobile or desktop. So knowing all this is very, very important. Then the last one here we have is to measure the effect, that is for HR, that the human resource sector or team. You can use metrics to measure the effectiveness of training programs by comparing improvement in performance to training costs. Now, it takes companies huge amount of money to invest in trainings for their new hires or even for upgrading their workforce, right? But if, for instance, you partnered with a certain training provider, you would want to know whether they are actually delivering the desired value, or whether your staff have improved after taking the program, to know whether you have enough justification for continued investment in that particular training, or whether you should look for a totally different training provider. So these are just examples. With that being said, we can now move. I think there's a slide that should come before this one. Let me quickly go back. What I want us to look at now is different classes of metrics that we can track. Right? I think I missed that slide. Where is it? Okay, yeah, this one. So here, this one is about just like different types of metrics that business can track. For the purpose of this session, I just brought about 3 of them out here for us to see. The first one is financial metrics, and then this one helps us to track the financial performance of one's business using essential indicators. I think I briefly brushed through that when I was giving instance of an investor um, monitoring the performance of a company or a particular stock to know whether to invest in it or not. The other one is sales metrics. They are used in evaluating the success of sales strategies, customer engagement, and all that. We still have for operations, these ones are usually focused on internal day-to-day activities in a company or in an organization. We still have other ones like marketing and all that. So those are different kinds of metrics you can track. It all can vary depending on your organization and your business goal, right? So with that being said, we'll look at financial. We'll pick them one by one and just give a brief um, example of like some key points about each of them and when we can use them, and even formula that we can use to calculate them. So I'm sharing my screen now. Here we are looking at financial metrics and then examples and formula. The first one here is sales revenue. And sales revenue, you can track them in a number of ways. Like there are a number of things you can use to track them. Oh, sorry about that. A number of things you can use to track them. And what are they? They help us to measure business revenue growth. That's that. But you can measure this from different angles. So you could be interested in looking at incremental. There's the growth, actual growth, instead of looking at it at a kind of looking at it in absolute values. Like you recorded 5 billion this year, you recorded 6 billion last year, and so on. You could look at them also in relative sense, such that you are comparing your effort or the revenue generated this year with that of the previous year, this month with that of previous month, this day with that of previous day, and so on. So with this, you could see that gap. You could see when you are moving up or when you are falling back, right? And the formula to calculate this is sales for this month. That's if you are looking at it on a monthly scale. You are looking at month over month growth. It's sales this month minus sales last month divided by sales last month. So the difference you are going to get here at this upper part gives you the difference, right? It could be positive or negative. Then you compare that with the value you recorded for the previous month. Then you multiply by 100. This here gives you the ratio, but you multiply by 100 here to get the percentage, right? So the difference here, if you notice that you have a negative value, the only condition to have a negative value is if sales this month is less than sales last month. If that's the case, then we are going to have a negative value sorry, if the difference between sales this month and that of last month is less than 1, right, then it gives you a negative value, then it means you actually made more sales in the previous month than the current month, and then that's a sign that you did not grow this month. Sometimes it could be due to seasonal nature of the business. Like we're already in Ember month, and we know that businesses usually make high volume sales in Ember months. By January, everybody must have exhausted or depleted their treasury. Therefore, sales in January may be lower than that of December. That one is explainable. But if it's just on a normal, let's say on a year scale, for instance, then it's expected that by the previous year, the cycle you passed through in the previous year and that you passed through in the current year are the same. There was still an ember month last year, that just like there is this year. So you have completed the same cycle, but you notice that the sales for this month, for this year, is less than that for last year. Then it could be a sign that maybe something did not really work out, or there was a major change in the industry that affected your business performance, right? So this metric can help you to track that as sales revenue. The other one here, which is still under sales metrics, is gross profit margin or GPM. What this one does is that it's a profitability matrix. Remember, it's focused on profit, gross profit, right? It helps us to measure the ratio of cost of production to sales. It's in a way used to evaluate efficiency, right? The efficiency of an organization, such that if it takes you 2 billion, or let me not use such a high value, if it takes you 3,000 naira to produce a product that you are going to sell 3,500 naira, right? Then you could, maybe depending on the industry benchmark, you could use that, have a glimpse of this to gauge your profitability, like whether it is efficient, in the sense that if it is a kind of raw material that you use that makes the cost of production high, then how can I now bring down the cost of production so that it now takes me 2,500 naira? By that single action, my profit would no longer be 500 naira but 1,000 naira. But you would not know unless you track certain metrics like this: gross profit and margin. It helps you, like I already said, to measure the rate, to monitor the ratio of cost of production to sales. So you now take that cost of production for the first instance, which is 3,000 naira. Um, the first instance, which is 3,000 naira. Then gross profit is when you now subtract that cost from the sales you made, right? So that is now 500 naira that you made. If you sell, if cost of production is 3,000 and you are selling this product for 3,500 naira, the gross profit in this case now is how much? 500 naira. You divide that 500 naira by sales, which is 3,500. That is 500 over 3,500. Then multiply by 100. Now, to gauge if another strategy would help bring down the cost of production, maybe you have tried another strategy that now helps you to bring down the cost of production, and you are now using or spending 2,500 naira on producing this product, then in that case, the gross profit is going to be 1,000 naira. So 1,000 divided by um, 3,500 naira that you still sell the product, you will see that the gross profit margin is higher, right? Which is a good sign. At least you are more efficient, and then you stand to, gain more from the product you are selling for the same sales cost. So instead of increasing the cost of product for your business, for your customers, you just simply did something that improved the process, and then you are still making higher profits, but customers would not have to complain that they are paying more because you've not charged them more. So these are metrics that you can use to know what to improve and what to retain. This second one, the third one here, is a net profit margin. And this one helps us to track how much net profit is earned for each dollar of revenue. A lower value of this metric, like mentioned here, indicates the need to adjust the price of goods or services or to reduce costs. This one is still not too different from the one we saw previously, which is gross profit and margin. Here, this one is more focused on net profit, right? After you would have reduced subtracted all other costs like tax and all those other things will arrive at the net profit, right? Then the formula here is net profit margin is equal to net profit over sales. Then you now multiply by 100. Look at this equation very well. Let me go back to the previous one. The difference is just that here is gross profit over sales. This one is net profit over sales. So it's not a big deal. And remember in the previous class, someone asked, how do we know these equations? How do we know this formula? And that was when I mentioned the need for domain knowledge, right? Even if you are not someone from business background, you don't have a background in business, then it could be time to brush up your knowledge of this so that you can now apply it. And then it's good to know this because Excel is only a tool. It is you who is the analyst that knows the right equation to call at the right time and then the right metrics and then how to calculate them. But Excel also comes packed with a number of these features. So the other one for financial is working capital. Working capital helps a business to know how prepared they are to meet short-term obligations. If there is a new investment now that requires urgent investment of 5 million naira, can the business meet up with that? If they take out 500,000 naira or 5 million naira from what they have in their account, will they be able to still pay their staff? Let's say the return from that investment is going to come in the next 5 months. Would they be able to offset the cost of service that they are getting from their staff or from their suppliers or vendors and all that? Working capital helps us to know that, and the formula here is just subtract current assets from, subtract current liability from current assets, and you know your stand. What this metrics helps us to do is that sometimes, maybe the insight you can get from something is that sometimes you could have the money to do something, but you cannot. It's safer to say I cannot afford this, even though I have the money, right? Just like an individual. If you are earning monthly earning is 80,000 naira, and you have something that will cost you 70,000 naira to spend on. Although you have, even if they just paid you today and you have that 80,000 naira in your pocket, it will not be a wise thing to just remove that 70,000 naira and invest or use that particular or make, to buy that particular service or whatever. Even if you have the money, or in that case, you have seen that you can't afford it, even though you have the money. So that's what this working capital helps us. One of the things it helps us to know. Okay, then we move on to the fifth one, which I guess should be the final one for financial metrics, and that is debt to equity ratio. And what does this one help us to know? It gives us an insight as to whether the company is just running on debt, right? You have over 5 billion naira in total revenue or asset, but how much of this belong to people, to others? How much of this were borrowed and all that? So it assesses the balance between debt and equity in the capital structure. And a ratio greater than 1 indicates that the business is over reliant on debt. You could also use it for personal evaluations. Maybe a lot of the services you are enjoying are more of things you borrowed. It's not really your own money, but you are living a life that is 2 steps higher than your earning power. It's something, it's a dangerous thing though, because the fact that it's not your money means it's still not your money, right? So this one helps us to know whether we can do something to bring down our debt so that we can boast that this is really our effort. Because running on debt can sometimes, can in many cases, give us a false sense of prosperity or success, which is not something sustainable. So the debt to equity ratio here, the formula is total liabilities all over total shareholders equity. Now you have to keep note that for you to really apply this, you need somehow to have the data. Knowing the equation is one thing, but having the data is another thing. So if the organization you're working in does not have this data, then it's time to start tracking them. Or if they do, then Excel only makes it easier for you to apply them. Now we've looked at 5 business marketing, financial metrics. Now let's look at sales metrics. Some sales metrics could be sales win rate. And what does this one do for us? This one helps us to know how effective our sales strategies are, right? If in 1 month 500 persons um, initiated certain sales process, and knowing the sales process could be maybe you are tracking the steps in the user journey. For instance, certain the group of 500 persons called to inquire about the cost of your service, or you sent out 500 invoices for that particular month, only for 25 to fulfill that, right? Then this is what win rate helps you to know. Win rate helps you to check, to get the ratio of total sales opportunities that ended in actual sales by the total number of opportunities you had. So if just 25 out of 500 finally made payments or closed the sale, or closed maybe paid for that particular product, then is it something good enough for your company? Maybe you would have established a benchmark or a KPI to get up to 25% conversion, 25% win rate. Then you know that by that 25% that finally closed the deal, out of 500, you are way behind the target. You should be looking at something close to 125 for you to be up to that 25% target that you've set for your company or organization. So it shows that there's a lot of work to do. The formula, the formula here is sorry. The formula is just getting the total number of sales opportunities won. As the ones won here means number of opportunities that ended up in actual sales. In our case, 25 divided by the total number of sales opportunities contacted. That is 25 all over 500 multiplied by 100 to get the percentage. That gives you sales win rate. The other one is total customers. This is one of the simplest. It's easy. Total customers is total number of customers. But it is easy, but it is also a very important metric to track, because it takes a growing customer base for a business to remain profitable, right? You need the number of people that patronize you to continue to grow, right? So it's an important metric to track, even as it is easy to calculate. And the calculation is just simple. You can just do a count of, if you are assigning unique ID to each of your customers, you can just do a count of unique number of customers that are still within your, that are still active customers. Let's say in 1 month, maybe your timeline, your time window could be in a month. If these customers still made a purchase in 1 month, then you can, if that's the metrics you are using to track active customers, you're expecting that an active customer should patronize you at least once a month. Then by the next month, if 500 did patronize you in the previous month, and then 480 now patronize you in this current month, then it shows that the other 20 are no longer active and you've lost 20 customers within 1 month. It's something you might want to probe further. Okay, so the other one here is really important. So I want us to look at it very well. And that one is customer retention rate. The English is actually straightforward. The ability of a business to continue to maintain relationship with their customer over time, right? If you at the time you started a business, let's say at the time you started a business, you started with 500 persons. 2 months into the business, they have all deserted you. Then it's not a healthy sign. So how do you track this? You track this by checking the total number of customers at the end of the period. To calculate this, you have to use time. Like this is all about timing. You create a certain time window. Maybe you want to calculate customer retention rate for the past quarter, for the past month, for the past week, right? Depending on the industry, that's where the industry comes again. If you are in the automobile industry, for instance, you would not expect maybe you are selling car, you are a retail car seller. You don't expect someone to keep coming back every month to buy a new car. It could be on average every 2 years that you expect them to come back and buy a car. So depending on your industry and what you are selling, the insight you get from that will help you to know the time window or time frame you use to gauge this. So in this case, the formula here shows CRR is equal to E minus M all over S multiplied by 100. E here is the number of customers at the end of the period. If it is 2 years period, it's the number of customers by if it's you are calculating the retention rate in 2 years. This is 2024. So you are looking at number of customers that you have active that are still with you today. Then N here is the number of new customers acquired during the period. If you are looking at 2 years period, you are considering those that you started with, those that you had in the year 2022. You are ignoring all the new customers you acquired between 2022 and now. You want to consider those that you acquired that you had up till 2022. How many of them are still with you? Because if you bring in new people that you recruited or you acquired, it might not give you a clear sense of what really happened. You want to check how, remember, you are trying to see how if you're able to retain these customers. So you are subtracting number of new customers acquired from the total number of customers that you have now. Then you now divide it by the number of customers at the start of the period. So this is now going to be total number of customers I have now minus number of customers I had or I acquired between the time period, which is 2022 and now, all over total number of customers I had in 2022. Then I multiply this by 100 to get my customer retention rate. Now, the need for customer retention rate cannot really be overemphasized because your ability to retain customers for a longer period of time gives a lot of insight into your customer service, the quality of your customer service, and high customer retention rate is also a signal. It's also a win for the business, being that it costs more money to acquire new customers than the old one, than servicing or maintaining the old ones. To acquire new customers, you need to invest more in marketing. Even if it's not costing you money to market, it still costs you time and the effort, right? How about maintaining the ones you already have? And then the ones you already have are more likely to continue to engage with your business and even tell people more about your business. So that's why this is very important. The fourth one for sales metrics is customer lifetime value. I will not dwell much on this because we have a session that would be dedicating to calculating this. But in summary, customer lifetime value is only about, it tells us how much anticipated returns will I get from this customer for the period of time they are with me in business. If you have seen from your data that the average lifespan, the average number of years a customer or customers normally stay with you, stick to your business is 5 years, how much are you going to get? How many times are they going to patronize you, and how much value are you going to gain from these people? The insights that is over that period. The insights from here would be helpful in justifying the cost or spend you would have to make in acquiring these customers, right? It gives justification for spend on marketing and all that. So the formula here is contribution margin multiplied by retention rate, which we looked at previously, all over 1 plus discount rate minus retention rate. So we are going to have a session on this, right? To look at it in more detail. Then the fifth one is churn rate. Churn rate is just like we've looked at retention rate, but churn rate is more like the reversal of retention rate in a sense. It measures the percentage of customers that discontinue using your products or services, and this helps to understand impact of customer loss. There are different ways that people can approach churn rate, customer churn. The first one is just by dividing the customers that you consider to have churned by the total number of customers that you started with at the start of the period. Then you multiply by 100 to get it. But the second one, which is simpler, is to to subtract the customer retention rate from 100. See that customer retention rate we looked at here, customer retention rate we looked at here is about those like your ability to maintain them for a longer period. Now, when you look at it in another way, it means those that stick till date. Then churn is about those that dropped off along the line. So if you subtract the one from the other, one from 100, you get the other. So those are different ways that people approach it. And I think that is the last thing we would like to look at. Like I said initially, it's more of a lot of boring theories for today, but we are going to make it, spice it up a little bit. So we now will be moving on to the next session, which is on let's see how to calculate this, right? How to calculate some of these metrics. So we have here total unique orders, sales growth year over year, total number of orders, profit growth, average order delivery time, net profit, average order return rate, net sales. So before we move into that, does anyone have a question yet? Okay. So thank you for your time so far. And to do that, we'll be using our usual, data set, which is Sample Superstore. Sample Superstore is a very interesting data set because it actually almost offers us every kind of data we need for like I mentioned before. Now it's a very popular data. It's a very popular data set for analysis, that is usually for teaching purpose, because it offers us different kinds of data we can work with. So we want to look at some of these things that we've been discussing all this while. So I will simply go to my data set, let me copy it, let me have everything for this session in this place. Okay, I would rather go back to that one we already cleaned so that we don't repeat too much. Let me go back to the one we already cleaned in session 2, I guess, which should be transformed with Power Query. So I'll copy that and quickly go to the folder for today, which is session 1. Yeah, so I have it here. Let me quickly paste that, and let me name this. What should I call it? Business metrics calculation. So this is the same with the data set you already have, which is the Sample Superstore. If you followed us till date in the previous sessions where we did data transformation, Then you remember this data set, which is the one we transformed with Power Query and saved as a new file. So I just opened that, I just copied it so that we have everything in the folder. Okay, so this is it. And in this data set, we have our different order IDs, order date, ship mode, customer ID, customer name, and all. Right now, the matrix we want to calculate. Let me stop sharing for now. Let me stop presenting for now. Okay. Let me copy the matrix we want to calculate. Let me paste it in Excel so that it will be easy to see. Let's see if it will work. Okay. Alright, nice. At least we have them here now, and these are the things we are going to look at. Okay. Alright. I just want it to look nicer. And I also guess the time I'm wasting here, you'll find it useful to even rest. We've spoken for the past 1 hour, so let me just. Okay, so we now have them 1, 2, 3, 4, 5, 6, 7, 8. These 8 values. Now let me just rename this to do, right? Then let me call this one worksheet. So this is what we're going to do, and this is the playground. Remember how to create pivot tables? We did have a session on that, right? So pivot tables are what we're going to use for this, to do this, and we would really find them very helpful because they offer us the tools to analyze and dissect our data in different ways. So the first thing we have here is total unique orders, right? So what are you going to do now? We have columns here, right? For each order, let me explain what each of these columns represents. For each order, according to the system this business uses, whenever a customer places an order, a unique ID number is assigned to it, and using their format, their order system, right? I can say we could see a number of let's say the year, right? I can see something like the year, then unique number assigned to that. So from here I can even have a sense of, or it could depend, it could vary depending on your organization. But what matters is that the order for each ID, I mean the ID for each order is unique. And remember, an order can come with different products in them. So if I ordered for milk and then chocolate, and I bundle them together in one order, the two of them are going to share the same order ID, but they are different products, right? So this, if I get the unique number of orders, if I get the count, if I perform a count of this, right, I can gain a sense of how many orders people have placed over time. Now, how do I start? Let me quickly copy this and go to pivot table. Add the pivot table. So I've copied this. Let me go to existing worksheet because I already created this worksheet. So I'll fold here to select this worksheet. Let me put it somewhere here. Alright, so I click OK. Alright, so I'll just call this I know that this row is for unique orders. style it unique orders, right? So I have this, and then what do I do? Okay, let me see. I can drag this to the values field, yes, and then you could see that automatically Excel has performed the count for me. Why did it know the count? That it is count. Remember in the previous sessions we did something, we dragged values to the value field. It was sum it performed. Now it performed a count because this is not a numerical data. It is not a numerical value. Remember, you can see it here as text, right? There's no way to start adding up text here. So it's smart enough to know this thing, the number of the type of aggregation to apply. So over the period, there were about 9,999 orders based on the count, right? And I can choose to still refine this further. I can choose to refine this further by sort of I want to show a breakdown of this by year or whatever other time frame I'm interested in. Then let me quickly go to the order date that contains the information about the year. I'll drag that to how do I want to place it. Let me place it by row, or it can be anyone though, right? Like this. So I am interested in year, so I'll remove this. Then I will also remove this. Then let me filter this. You can see that this one orders before first of is it first of March 2024 or 2014 rather, they don't contain any value, so I can just come and uncheck it. And this one too, because they don't contain any really useful information. So I have 1,994 orders in the first year, 2,100 in second year, 2,500 in third year, 3,315 in fourth year. Total is 9,999, right? And let's say I am not really interested in seeing everything. Let me drag this to here rather. We'll see something. Let's say I'm not interested in seeing everything like we've seen in the previous one, so I can easily filter. Let me say I'm only interested in the past 2 years. This, and then I want not just to see the absolute values, but to see the growth. Okay, I want to remove this grand total. I'm not interested in it for now. Remember how to do that? Go to grand totals and turn it off. If I want to see if I'm growing or not, then I can do that. How do I do that? Let's say I want to do year over year growth or orders. Okay, orders year over year. Let's see if as years go by, people are placing more orders or people are forgetting my business and going elsewhere. So how do I do that? Remember, this year minus last year all over last year multiplied by 100 will give me that. So how do I do that? I would enter the formula here. Zoom in. I'll enter the formula here, which is equal to, then I can choose to select the cell here. But let me just type the cell value. This is D, this one is D6. Look at the column first, then row followed. A quicker way to understand, to see it is, you see that, okay, yeah, I think this is just straightforward. This I want to pick this one, which is the value for this year, and then divide by, I mean, subtract this one from it, then divide by this one. So the cell corresponding to this is D6. That means I can open parenthesis D6. When I enter D6, it selects the cell. You could see this one highlighted in blue, right? Then minus, this is C6. C6. You see that one selected in red, right? Then I will close my parenthesis, divided by that of last year, which is C6. At this point, I've gotten the value I need, but I want to express it as a percentage, right? So let me still close it just to make it readable. I just now at this point I'm multiplying everything by 100. That is multiplied by 100. So we have 28%, right? We have 28% growth. But I can choose to stop at, I mean, without multiplying it, so that I can format it, right? Let me say I stopped at this point. Let me remove this. I stopped at this point, and I've gotten what I have now is like the ratio of it, right? So I can still format it. Instead of typing the multiply by 100, I can now format this as a percentage. So I can click on right click, then I can click on go to, let me zoom back so I can see what I'm doing. So I can now go to format cells, right? Click on that. Then instead of as a general, I can select percentage. Then I can, let's say, one decimal place. So it returns back my 21%, 28.1%. That is the, and it's a positive value, right? So it shows that my orders are growing, right? Last year I have more orders this year than last year, and I can even be more creative in doing this. Let me just quickly create another cell. Let's say this is what I have. Let's say this is a 2,300. I want to create a scenario, a scene for where a situation where I have lesser order this year than the previous year. This 1,500, right? So if I, let me see, if I put this down, you will see that this formula is replicated here, right? If I click into this, instead of C6 that we had previously and D6, Excel automatically repeats the pattern here. It picks this one, subtract this one from it, divide by this, right? And then format it as a percentage. So I now have minus here, minus 34.8%. So my orders are declining, they are falling down. I have to do something about it. So what I wanted to show you is how to format certain cells, custom formatting. Now, it's okay that I have a negative here, but what if I want to apply value? I want to apply coloring. I want to color code this so that when it is negative, I have something like red to quickly spot that. When it is positive, I'll have it as green. So let's see how to do that. I selected the cells I want to format. I right clicked and then clicked on format cells. Now this time around, instead of selecting percentage, what will I select? I will select custom, and then it shows us this. These are different ways we can format. There are different types of formatting we can apply, right? Okay, so if I scroll down, I will still have many of them. Many of them. Now, I want to currently look at the format that was applied to it, right? I want to kind of apply some kind of coloring. So let me just quickly do something. If I enter this, let me call it green, then this percentage, let's see if that works. This percentage, then every other thing inside here, I want to put minus 0.0%, close it. Okay, let me see if I have red. Did I enter it correctly? Let's see rather. Okay, I think it should come outside. Let me put it somewhere here. Okay, right. I would explain everything. Okay, okay. So guess what happened now? I now have green for when the orders this year are higher than orders for the previous year. But in the second case whereby the orders declined, I have a red, right? The number showing a red, then a parenthesis covering the number, actual number is in parenthesis, right? And color coded red with the negative value. So let me just quickly edit that and show you what I did, what the syntax represents. I can, instead of even typing green, I can just type color 10. Color 10 will give me a kind of a darker shade of green. So color 10, right? So when I click OK, I now have a kind of a more appealing shade of green rather than what I had before. This is the previous one. This is the current one. So to show you the syntax, watch very closely. First of all, the color is entered in square brackets, right? In square brackets, I enter the color. Then you could see something like a semicolon here. Semicolon here separates the positive value from the negative value, right? Everything coming after the semicolon is how the value should be formatted when it is negative, when it is less than when it is less than 1, rather when it is less than 0, like whenever I have a negative value, whatever is inside here is what the formatting should be. So in this case, I used semicolon to separate the positive from the negative. The one here is when the value is positive. So I said color it, give it a red color, and then the 0 here represents the value. Then this one is the decimal place. The one coming after this thing is the decimal place. Then the percentage here. Format it as a percentage. Give it a color of green. And then in 2 decimal place. That's for positive. Then I now put semicolon here. Then I now open another square bracket. I now said whatever thing here is now for condition when it is negative value. I now said color it red. Then put it inside parenthesis. Give it negative sign. Then still format it as a 1 decimal place value in percentage, right? So that is just what the syntax is. So it's just a matter of playing around with all this here to see what each of them represents. Let me remove this parenthesis. Let's see what it will look like. I click on OK. So you could see now that it's giving me the value. There's no more parenthesis, but then there's still the red and then the negative sign. So that is the formatting for you. I just wanted to quickly show you how to format it. You would find this useful when we start doing certain things with tables, and when we start calling these tables, designing our dashboard. That's when this becomes handy. All right, so I have calculated the count of customer. There's this unique count of customer orders, right? It gives me the total number of orders, right? And then I have calculated the percentage and seen that my orders are growing. Okay, so the other thing we have is I think total number of orders. Yeah, I think I've done that. Average order delivery time is another important metric when you are probing into. Maybe you have a different courier service that you normally utilize their service to deliver your orders, and recently you started noticing that people are complaining of orders taking too long. Remember, we have orders that were returned, even in this data set, returned orders. What happened? Why are people returning orders? I think I have not offset for returned orders rather, so I will still do that here. But maybe you are investigating what could be the issue why people are returning all these orders. Then likely it's because maybe they are taking too long to deliver these orders, and then by the time they deliver it, the customers are no longer interested and all that. Okay, so what do you do? Let me quickly remove filter for returned orders before we proceed. So I'll drag this to filter. Then I'll come here and filter for false. I'm filtering for false because I'm looking to calculate for orders that were not returned. Remember this column. So the value fell, right, as expected. Okay, so the other thing we want to calculate now is, what's that again? Average order delivery time. Okay, so how do you go about this? If you go back to your source data, you see that you have order date, and then the date the transaction was initiated, right? That was the day the order was placed. Then ship date, the day the order was shipped. Let's see if we have the order arrival date, the day the order was received by the customer. Really, don't we have that? Profit discount subcategory category start date segment ship mode. Oh, unfortunately, we don't have the date that tells us the day the order was received by the customer, right? But let's just see if we can change this to something else, something like average order data, as in the average number of days it takes to ship an order, right? I wish we had the column here, or maybe during the transformation stage we omitted that. I can't really remember what happened, as if we actually have it. One way I can do it, I can actually come here, I can calculate to achieve this. So instead of that, let me rename this to average order, average date, or average day to ship, or average time to ship. Average time to ship an order in days, right? Now, if you look here, you will see that the difference in time. Remember, this is already shown as a data type. That's one of the reasons you need to transform your data to have it in certain formats. If this was just a plain text, Excel will not be able to apply certain Excel function that helps us to calculate days, difference in days, right? But luckily enough, we have transformed this data, and then we can perform that operation. So let me just quickly insert a column here. Let me quickly insert a column here so that we will be seeing everything if I proceed. So I can call this one time to ship, and this is going to be a formula or a function I will apply here. So Excel has a function called days. So I will now just type equal to days or day. Let me see, it returns the day. Oh no, this is day. This is days. So let's see what days does. Return the number of days between two dates. Yeah, that is what we need. So I have entered here, and it requires two parameters. The first one is the end date, and then the second is the start date. And I want to calculate time to ship, meaning it's the day. The end date in our case now is going to be the ship date. Then the start date is going to be the order date. The date the order was placed, the date the order was shipped, minus the date and then minus the date the order was placed, right? So I would just simply select this for the end date, then I'll use comma to separate it, then start date. I'll close the parenthesis. Why did it format as something of what format on the calculator? Control Z. Draw. Okay, so something is not working yet. Let me see if I can change the type. Format cells. Let me format cells to let me format it to number and see. Okay, here, so we have it. This is a 18th of March. The order was placed on 18th of March and it arrived on 23rd of March. I mean, it was shipped on 23rd of March, which is how many days? 5 days, right? So it was just the formatting that restored it back to what I was expecting to see. So whenever you see something like this, don't panic. I have it in two decimal places. It's not necessary. I just put it at 0 decimal place. So this is 5 days, 2 days, 7 days, 2 days, 2 days, 2 days, and so on and so forth, right? So on average now, I can now calculate the average of this, right? I can now calculate the average of this. Now, there's something I would like to do. Let's try out something. Instead of coming to do it directly here, let's do it in our worksheet instead. So I will just quickly delete this. Let me quickly delete this and see if let me quickly delete this. So let's go back to our worksheet and see if we can apply calculated columns here again, if that will work. So I'll select this. Sorry, go back here, select your table, then insert pivot table. Let's try out something existing. So I select my worksheet once again. Let me place it somewhere below the first one. Click, then OK. So I now have my this. So let me kind of really be interesting. Let me try something and see. I have not tried this before, so it stands to either work or fail, but we'll learn from whichever process. This is I'm looking at order dates. Yes, so I'm not interested in the year. Remove field. I'm not interested in the year to remove field. So this shows me this is order dates in months. Okay. Let me try. Let's see if it doesn't work. We learn from that. That's this one is showing me the order date. But sorry, was the order date? Okay, ship date too. Where do I drag this to? Ship date. No, doesn't make sense. No. Doesn't make sense at all. Ship date. No. What I wanted to do does not really apply here. So let's just go back to our original table, where maybe if we find a better way to handle this, then we'll come back to that. So I initially calculated the column that says time to ship, right? So if we go back to this worksheet, then chances are high that that column we calculated has not reflected. We don't have time to ship yet, but it's an existing column in our original data, in our source data, which we just created. So let me see. Let me refresh that. Sorry, go back here. Let me refresh this and see if that would show. Let me refresh on. And then it's still refreshing. Okay, as it shown, it's still refreshing. Okay, so we've refreshed it. So time to ship is now showing here, right? So what will you do next? What I want to calculate in this find the part the book. Oh, sorry. I think I know the course. The course here is that since I copied the data set from where it was originally, I have not updated the data source. I have not updated the source to the new, like the relative part from where I copied it to where it is now. Is missing. So just close that out. That will not be an issue. I can easily correct. Come on. Can easily correct that, but that should not distract us for now. At least we still have the column we need. So let's go back here, create pivot table again, insert pivot table, click that, then existing worksheet, select the worksheet, select the cell where I want to place it. Let me place it here, click OK. So now that we have the time to ship, right? I want to calculate the average time to ship. So that's the value we have, time to ship. The default behavior is to calculate the sum, but now I want to calculate the average. So value field setting, I would want to change the calculation. So instead of sum, I will change it to average. Then click OK. So on average, it takes about 4 days to ship an order. And to know if this is growing or not, let me look at let me break it down by years and see what it was like in the previous years. So let me look at the previous order date, right, to now show me the previous years and see. Or okay, there are a lot of things we can do here. We can do it as in to see it in the quarters range to see if maybe seasonality has an impact here. And from what I can see, it's actually the same. I'm not sure seasonality is a factor here. By seasonality, I mean I was expecting the Q4 to have higher order date, but it's not the case here. Q4 is 3.95, Q4 is Q3 is 3.98, 3.696, 3.90, which is not significant. So seasonality is not really an issue here. Instead of that, let me go back to here. So let me just add order date and then let me look at it at the year time scale. Remove this, then remove this. So what I have now shows me the order date, the average time to ship for different years, right? I would like to know if they are growing. I want to bring down the time to ship as much as possible. Let me remove this grand total, turn off. So I have this now. In 2014 it was 3.9, in 2015 it's 4.0, 2016 3.95, 3.90. Now my goal should be to reduce this value, ship date, I mean the time to ship, as much as possible. I should reduce it, right? So I want to kind of calculate the can be a kind of sense of we can still apply the formula we used for year over year growth. Is it rising or falling, right? Is it rising or falling? We expect it to fall. So instead of placing it as column, let me drag it, I mean as row, let me drag it as to column so that we can have a sense of this. And for the year I am interested in, I want to see it for the previous year and the current year. So I do this. So I can now do time to ship. Should I say year over year? Okay, average time to ship year over year. AVG, average time to ship year over year, which will give me equal to current minus previous all over previous. That will be D13, 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 13 minus C13 divided by C13. Right? So what did you notice here? In 2017, average time to ship actually fell. So like I mentioned initially, we want this value to fall, right? So we are in line. It's a good sign. So how do I now format this? In this sense, unlike here I want this value to grow, but here I want this value to fall. So in formatting it, I would want whenever this is positive, it should show as red. Unlike in this case, Whenever it is positive, it should show as red, meaning that it is rising. I should bring it down. But whenever it is negative, it should show up as green. So let me do that quickly. I'll format this. Go back to the same formatting we applied to the other one, custom formatting. Let me see if the formatting we applied was saved, so I can just quickly edit it. And then I think this was it. No, this was it. Color 10. Yes. So instead of that, now I will now put red here, red here. Then instead of red here, I will now put color 10. And paste this color 10. Then the sign, remember, whenever this part is showing for when it is negative, but when it is negative is what I really want. When it is negative, it should show as green, right? But when it is positive, it should show as red, something that needs to be brought down. So let's see. So this is a good sign for us. Let me remove that parenthesis. It's not doing any special thing there. So I will just remove that. Remove that. Or I can even remove this negative here. So far I know what I'm looking for. But this could be misleading. So let me take it back. Let me take it back and then add negative and see. So the person interacting with this report should really know the metrics and what they are looking for in the metrics. So this is okay. So this is a good sign to tell me that the average, the year-over-year time to ship is really falling, which is a good sign. It fell by 1.2%, which is a good sign. Okay. So at this point, I also want to confirm once again that we are still together. Are you with me? Okay, so we've gotten the time, that's the average time to ship, right? And we've seen that we've reduced it between last year and this year, we've reduced it by 1.2%, right? Which is not so significant, but still something better than um, having it rise or increase. Okay, so the other thing we'll look at now in our to do is average order return rate. As a business, you may want to track whether people are beginning to return more orders than usual, right? And a quick way to do that, and to know whether this metrics is really important. Remember, we discussed KPIs and metrics, right? So if you just notice something strange really happening in your business, it's time to apply your data to answer those questions. Or if you are proactive enough, you should have this data tracking these metrics so that you don't wait for things to break before you can fix them. So to calculate average order return rate, remember we have our column here that contains data about orders that were returned, right? If I scroll to the right here, we could see orders that were returned during the period. The ones showing true, like this one, means the order was returned, right? That's the one showing true, shows that the order was returned. But the one showing false shows that the order was not returned. So we're interested in seeing the ones that were returned. Are they rising by the year or are they falling, right? So let's calculate that. So I'll quickly select my table, then pivot table, then existing worksheet. Then let me select the worksheet, which is this. Let me put it somewhere here and click OK. I now have the pivot table here. And then I'm looking at returned orders. So returned, what do I drag it to? I drag it to my value field and it quickly performs a count for me. I don't want count, I want average. Will it be possible? No, this will give an error actually. So a way to handle this, remember this is not a numerical value, right? So it performs a count. So I think the best option would be to follow the same step we followed in the other one, whereby we, or I think there's still what we did was still right. There's still a way to go about this. Yeah, it's currently showing count, but I want to see whether this count is increasing by the year. So let me go back again to order dates and drag order dates to perhaps column. Or let me drag it to row first, right? So dragging it to row now shows me the number of returned orders for each year. Okay, so I would remove this quarter and then remove order dates here. So I would also remove grand total. I don't need this. I'll remove this, turn it off. Then I now have it. In 2014, there were 1,994 orders returned. Sorry, take note, I have not filtered it. Remember, I have orders returned and not returned. This is just simply counting the number of rows in this column. So let me apply this as a filter also. Remember, it's both the value and the filter. So I can drag it here as a filter. Then I want to perform filter for number of orders returned. In this case, it's going to be true because I'm interested in orders that were returned. Then I click on OK. So the value reduced as expected. So 151 orders in 2014, 163, 197, 290. Right? So that's the number of orders. And then it may look like we have more orders returned in 2017 than in 2016. But at the same time, it's also possible that we have more orders in 2017 than in 2016. So the higher the order, the higher the number of orders, the higher the tendency that people will return those orders. It does not really mean it's a bad thing. It may not really be a call or for concern, because if I recorded 2,000 orders and 50 were returned, and I recorded 1,000 orders and then 30 was returned or 30 were returned, then it's better that I have 2,000 orders with 50 returned than, because when you check the proportion number of returned orders relative to the total number of orders, you see that the former is quite lower. So in our case, instead of just calculating this directly, I would also want to compare this with the total number of orders placed during that period. So I would go back to orders. There's order ID. I've already filtered. I'll go back to order ID and still drag it to row. Oh, sorry. Is it row? Row will be better. Let me see. No. So I want to place it side by side. So let me drag. I think a better way to do this would be we have return, we have count of. I'll drag this one to value because this is another value I want to look at. Yes, this is what I want. Count of returned order ID, right? Then something is quite interesting happening here, and the issue here is that I have filtered already for orders that were returned. So even when I look at total number of orders, unique order ID, it's still going to give me the maximum number of orders I have here for orders that were returned, right? So that brings in some kind of a dilemma. So what I will do is, let me do for the first case whereby I only filtered for orders that were returned. Then I can now do for another case whereby I have orders that were not returned. Then I can now calculate the proportion. I will quickly do that now. I would first of all remove this. Then I'll duplicate this pivot table, copy it. Or before I do that, let me take this one to column so that we don't have occupy much space, right? So I'll copy it, copy, then I'll paste it somewhere here. Let me paste it somewhere here. In this one, we're not going to apply any filter. Let me paste it somewhere here. Then it did not format as pivot table. So let me just create another pivot table. Let me create another pivot table. Go back here, copy the data, which is already copied, insert, then pivot table. Paste it somewhere here. Okay. That's also not valid. I think I did not copy it well. Let me copy it. Insert, pivot table, existing worksheet. Let me fold this to select. Yeah, fold this to select. Select the cell. Okay, so we have our pivot table now. I'll just simply duplicate what I've done before, but this time around, I am filtering. I'm no longer filtering for orders that were returned. I somehow feel that would be a more intuitive or more elegant way to do this. But for now, let's move on. So I'll drag this order ID now, count of it, then year, the order date. I'll add it as a column, just like we have in the other one. Then let me filter for years that don't matter. Filter for this as well. Click OK. So we have this now. I'll remove quarter and then I'll remove order date. Right? So we now have, then I'll remove this grand total. I don't need that. Remove it. So we now have something similar to the first one, only that here I have filter applied for only orders that were returned, but here no is the total number of orders. So I want to now check the proportion of orders returned divided by total number of orders for that particular year, right? So this is why I'll calculate it. Order return ratio. Order return ratio, right? So I may want to do it for all the years. So let me say 2014, 2014, 2015, 2016, 2017, right? So this will be it. Copy this and paste here for those years, right? So I would do this all over this, right? So equal to this cell C19 divided by C24, right? So I have 0.07, this 0.08, 0.08, 0.09. So you could see that it's actually rising here, right? So what next would make sense here? I can go further to compare. Like in the year before, we had 0.08, but in the year after, we have 0.09. And I want to bring down this order return rate as low as possible. So I would expect this to fall. Now we're looking at the proportion, no longer the absolute values. So it's justifiable enough now to want to bring this down to be lower than this. But in this case, we have this one higher than this. So this is where we now spot out the issue that there's actually a problem. As our customer base is increasing, it's likely that we are no longer prioritizing customer value. Or let me, before I conclude, let me format this to be the same decimal place to make sure I have everything figured out first. So let me just put everything to number. Let me put everything to 2 decimal place here. Okay, so let me do that. So you can now see it was 0.08, 0.08, 0.08 for the first 3 years. But this second, fourth year, it's now increased by 0.01, right? Okay, so if I want to compare the rise, this is supposed to fall down, right? Let's say I want to compare the previous year and the current year. Now, that is the same year over year. Do year over year here. So this one is now going to be equal to this minus this all over this equal to this minus this, that in parentheses, all over that of previous year. This is 0.15%. Now you would expect this to be a red value even though it is positive, because I expect this value to fall. Meanwhile, it is rising, right? So let me format that like we did before. Go back to format cell, then select custom, or instead of doing that, I already have the formatting for this one. I already have the formatting here. What was that? I already have the formatting for here, and this one is supposed to be green when the value is red. I mean when the value is negative, and that's the same thing I want here. So let me copy the format here. Copy, click on this. You can double click if you want to use it multiple times, but I'll click here. So you see that it has turned red, right? Which is what exactly I want. So what that means is that this value has increased by 14.9%, our order return rate. So return rate year over year. So between last year and this year, our order return rates increased by 15%, which is not a healthy sign. So we need to know what really went wrong. Is it our customer service or our logistics unit that is no longer delivering? Do we need to expand this? So we've seen a very important insight here that could help in improving our customer experience. So that is it. The other one we'll look at back to our to do. We've gotten this as well. So now let's quickly do year sales growth year over year, profit growth, net profit, and net sales. Okay, so I think we are making a very good progress, though this is just a worksheet, a kind of a playground for us. And okay, let me copy this sales growth, copy it and paste on sales growth, paste it, sales growth year over year. Then what else? In calculating sales growth year over year, we've done this in the previous session, but I'll repeat that. You still apply the same pivot table. So select this, then pivot table, select existing worksheet, then select the worksheet, select the cell. Let's make it somewhere here. Let me give much space because I will apply filter. So that's it. The first thing I want to do is I need to really consider returns, orders that were returned, right? Let me not use that. Let me not calculate that in the sales to not confuse. So I would remove false. I'll apply for false. So I'm looking for orders that were not returned. Okay, so in that case, I have it. Then let me now go back to my sales field column. Sales, drag it to the sales field, and then let me break it down by year once again. Order date, I can choose to drag it to column. Then I don't need this quarter and the rest, quarter and order date. If I want that breakdown, I can leave those options, but I don't want them for now. So I'll turn this off as usual. Then 2014, 15, 16, 17. And then sum is the value, right? Okay, then sum is the value, right? So the other thing we want to do is we are calculating year-over-year growth, right? So to calculate, I would want to calculate for all the years and see whether it's rising, but I'm more interested in the last year. Then you will see that in the first year there was no sales for the year before it, right? So if I now do this minus this, that means the sales for that year is 0, right? It will be right to say that the sales for that year is 0. So let me quickly ideally there should be a value for this is the value for 2014, right? Ideally there should be a value for, let's say, 2013, but then perhaps our business has not started, we've not started operation at that time, but I would want to calculate for all the years and see. So for the first year I'm going to have a value quite different from what we'll see next. Then how do we do that? Let me put it here. Equal to open brackets, because this is an empty cell, it's just going to be equivalent to 0. This, oh sorry, not that, the one before, that is this okay, try to do that. This is 20, this is the value for 2014, right? Then this is value for 2014. I want to calculate year-over-year sales growth. A wise way to do that, if there's no point calculating for the year before, let's say for 2014, because by 2013 there was no sales. So I would be wiser to start from this 2015. Let me quickly do that. So it will now be equal to open parenthesis, this one which is 2015, which is in cell what? Cell D, cell D37. That is the sales for 2015. D37 minus C37 all over C37, right? That's minus 0.09. I'll quickly drag this and see if the formula was correctly applied. So this one is supposed to 2016 is supposed to be E37 minus D37 all over D37. Yes. Then I think Excel got that right. So in the second year, in the first year, the growth, in the second year, the growth was lower than. Then in the third year, I started picking up. Fourth year, there was a fall, and so on. So year-over-year growth, let me format that so that if it is red, if it is positive, it should show green. Instead of doing that, I already formatted it somewhere here. The behavior I'm searching for is similar to this, whereby if it is positive, it should show green. So I'll copy the format here and then apply it to these cells. 1, 2, 3. Yes. So minus 9.8% in the year 2015, growth of 37% in the following year, then the fall of, growth of 15%. So what this part is telling us is that this is comparing the one for 2017 and the one for 2016, right? So between 2016 and 2017, we recorded a growth of 15%. Between 2016 and 2015, we recorded a growth of 37%. Between 2015 and 2014, we recorded a loss as a growth of minus 9.8, which is a fall, a decline, right? So that is what this is showing us. So let me call this sales YOY. Okay, that's for sales. We can also do this for profit. So I think by the time we do for profit, we would end the session after doing for profit, since we spent much time doing this. Now to calculate for profit, we would have to put our pivot table here once again. Insert pivot table, current existing sheet, go to the worksheet, select the cell, and then plug in the pivot table. Then we already have a column for profit. I can now drag this column for profit, place it here. Then order date. Let me do similar to what I did before. Then I don't need quarter. I don't need order date as usual. Then I don't need grand total. Okay. And then I filter for the time, date. Remove this, and then remove this as well. Okay. Similar to what I did before, I'll just copy. Let's see if I can copy. Let's see if copy option. Will it help? Let's see if it will help. If it doesn't help, nice, it helped. I will simply change this to profit YOY. Profit. Excel is so smart. What did Excel do here? Okay, I have no filter. Let me filter for returns. Then we can now see the actual value here. So this is returned order. Then I'll explain better. It's currently showing all sales, but I need only for false, those that were not returned. Great. So what happened here was that if I click into this, the formula to calculate sales growth and then profit growth is still the same, just that this time around we're looking at profit instead of sales. So here I told Excel, pick the profit for current year, subtract from the previous year and divide by the previous year, and then format it. The same with what we did here, pick the sales for current year, subtract from the previous year. Subtract previous year from it, divide by the previous year. So because I copied the same equation, the same formula pasted here for me. So I did not really need to do much there. So I can now see that in the year 2015, there was a growth of 21% in profit. 2016, we rose to as high as 53%. But in 2017, it fell back to minus, it was a loss actually. What could be the problem? One possible problem could be that the data for the 2017 is not complete. So let's see if that was a fiscal year. Is this data up to December? Let's see. The data for December for 2017, we have up to September. Select date. Column. We have up to November. Wow, okay, December. So it was actually a loss. But if we assume that we're already in the fiscal year and then the data is complete for the year, and then we are recording a minus for that value, it shows there was actually a loss for that year, and it's cause for concern. So back to our worksheet, we have minus 1%. So it was actually a loss in the year before, in the year 2017, right? So this is something we can prove further into. Now we've done a lot here. We still have more to do. The other things are, perhaps you can do this as an assignment, how to calculate net profit and then net sales using pivot tables. You can do that, right? Using pivot tables, and then this main source, we can actually achieve that. So on this note, I want to thank you for following me through to this point in this session, and I hope to have you join me in the coming session. Thank you very much, and do have a wonderful day. Kenneth is my name for Analytics Hive. Bye. See you next time.